best to indeed make this simpler. I hope that will be easy for you to understand. But we recognize that options are and frequently feel like an intimidating subject. So our main goal here is to make sure this is fully approachable, easy to digest, and that will rely both on our skill as teachers, but also on your willingness to share your questions. If you will go ahead and take a look down at the bottom of your screen, there is a link labeled question and answer Q&A. If you go ahead and click on that, you can send in your questions now or at any time throughout the presentation. Those are sent privately to Nick and myself, and we will go ahead and answer them for the class because you're likely not the only one with those same questions. So we look forward to addressing those throughout the presentation. Though this is one of many option classes that we teach, we do recognize that this is a little bit of a special opportunity to spend mostly focused on your questions as we talk about the very basics of options trading. We're going to talk about the very beginning. What is an option? We're going to break down the various strategies that exist with options trading. We'll even remind you some of the breakdown of how to read an option symbol when you see it in your account. We're going to spend a lot of time on these different topics, but again, focusing more than anything on the questions that you have. So let me go ahead and introduce first options themselves. I hope that you've at least gone out there and read about options, maybe even traded an option or two in your account. But today we're going to bring you up to speed on everything that options are. So that's going to rely, number one, on an understanding that options are contracts. And a lot of the verbiage, a lot of the words that describe options borrow from the insurance world. Insurance contracts, and here we've got an option contract. There's a premium involved, there's a buyer, and there's a seller. If you start thinking of those terms in similarity, an analogy to your insurance contracts, you'll find that the ideas may sink in just a little bit quicker. If you are the buyer of an option, then you have the right to do something. You can make a claim on your insurance, if you will. But the thing that you have the right to do on this options contract is either to buy or to sell. That's depending on what kind of option you select. But that purchase or sell of shares will be for 100 shares of the underlying security up until the expiration date. And you can do that at a fixed price, a guaranteed price. We don't know what the stock will be worth, but we know that if you choose to use your option to purchase those shares, you already know your price. It's like locking in a deal. It's saying that you have a coupon that you're headed to the grocery store, and even if the toothpaste is $2 per tube, you can use your coupon and get it for $1. You can use it at your fixed price regardless of the value of the existing market rate. Likewise, a security, an option to sell the underlying, gives us the ability to sell your shares. It's like getting a guarantee from somebody that they will buy it from you at a given time, but you are still the one with the right to do it, the ability to make that decision. Whereas the person on the other side is the seller, and they have an obligation. In fact, they have picked up the requirement that they have to do this. If you were the buyer of the option and you have the right to buy, well, the seller of the option is the other half of this, and they are obligated to sell shares to you. They are obligated to buy the shares from you if it was a contract to sell shares. But regardless, we note that already we're reusing words, aren't we? We're buying and we're selling. We're buying as, are we buying the contract? Are we buying the shares? What's happening here? This gets very nitpicky in the details, and we need to make sure we understand what we're talking about. When you buy the option, you are buying the right to do something. If you sell the option, you might think of this not as selling like when you choose to sell your car, when you chose to sell a home, but rather this is like the insurance salesman selling insurance to you. That is the beginning of that insurance contract's life, but they sold it to start with. Selling here is a strange term, but what it means is they are bringing in a premium right up there at the front. You are paying them, but the seller is then obligated to do something. They are put on the hook to do something if you, the buyer, choose to take action. And so that's the trade-off here. If we are the buyer, we think of ourselves as the one that has rights and has control. The seller doesn't have control. They are at the whims of the buyer. But why are they willing to take that risk? They are willing to do so because you pay them upfront a premium. Now, there are two styles of options that exist in terms of how they are exercised. There can be either American style options or European style options. American options, I like to think of as the land of the free. They are able to be exercised anytime you want. So if your option was to buy shares, you could buy them today, you could buy them tomorrow, you can buy them the next day, whenever you would like. You can exercise that contract. But a European style option only gives you the right to exercise at the expiration date. This applies mostly to options related to index trading. And so if you are going to find an option that tracks the S&P 500 as an index, not an ETF, but actually the index itself, then you'll find those tend to be European style exercise, whereas American is going to cover pretty much everything else.
Yeah.
Anything on a stock, anything on an ETF. Anything else to add here, Nick?
Well, we always get asked additional questions on this whenever we host this session. How do I know for sure, what I'm trading, it's American style or European style? And bluntly, if you're trading an option on a stock or an exchange traded product, if there's an actual underlying, it's almost always American style. I can't actually think of an example of a standard option contract on a stock or an ETF that is not American style. On the flip side, with indexes, most indexes are European style. They're settled like in cash. They're not exercisable early. And I can actually think of some examples where that's not the case, where they are actually American style, but most indexes are European style, but virtually all stocks or ETFs are American style. And so until you get to a little more of an advanced option trade where you start to actually trade options on indexes where you're looking for specific types of options with those characteristics, you can typically assume that if you're trading an option on a stock or an ETF, it's American style and you can exercise the option at any time. It has nothing to do whether they trade in the US, they trade in Europe. It's exclusively dealing with whether you can exercise them early or whether you have to wait until expiration to exercise and only exercisable at expiration. With that, though, I do want to elaborate a little bit more on a couple of the great points that you made there, Jacob. And I do also want to let the audience know, please send in your questions and your comments. We've had a couple of great questions that I do want to touch on. It's what makes this session unique and different than just watching a recorded version of this particular session. That said, Mike asked us about, if you're buying an option, it goes up in value. How do you take advantage of this? And let's take Jake's toothpaste example. And I want to modify the wording a little bit from, being a coupon, because it's not 50 cents off the toothpaste, where, hey, if the toothpaste is $2, you're buying it for $1.50. Or if the toothpaste is $5, you're buying it for $4.50. It's a stated price. You're paying $1 for the toothpaste. Now, imagine you're reading the newspaper and you see these toothpastes are on sale for $2.50. You bring in your coupon, you can buy it for $2.50, but you get in the store and they're $1.99. Would you rather just pay the $1.99 that they're for sale on the shelf, or use your coupon to pay $2.50 for it. Well, in this case, your right to buy at that price might not be worth anything. But what if you walked into the store and on the shelf they're worth $5? Well, now your right to buy that toothpaste for $2.50 is actually worth something. It's going to give you a $2.50 discount. Now, let's say something extreme happens and the price of toothpaste goes up a lot. What comes to mind when it comes to toiletries like this is think about COVID and trying to get toilet paper. It was impossible. The price, doubled overnight virtually. Well, let's say toothpaste is normally $5 and you have the right to buy a tube at $2.50, not discounted, but at that price, and something happens and now toothpaste is worth $10. Well, you still have the right to a little bit of a more complex question that I want to address with this slide. We're asked about the option Greeks. Now, we're not really going to go into much depth in this session on option Greeks. That's really more of an intermediate or advanced topic. Now, for those that want to take your option knowledge to the next level, I strongly encourage you to learn more about the Greeks. But they then describe some of the risk differences between stock and options. When you buy stock, when do you have to sell it? You don't really. There's some very famous stories about, whether it's Warren Buffett with Coca-Cola, or I remember hearing stories about, a secretary working for Coca-Cola and buying Coca-Cola stock, and then 7 years later having millions of dollars in Coca-Cola with appreciation from Coca-Cola stock. They don't necessarily have to sell that. Where if you're purchasing an option, that's a decaying asset. It has an expiration date. And as such, there are some of these other concepts dealing with time premium or intrinsic value that we'll talk about near the end of the session. But it's important to think about that options are decaying assets, where stock doesn't. You can buy an old stock for a year, 5 years, 10 options, not necessarily. With stock, you have the right to vote those shares. You're also going to receive dividends for that if the stock pays a dividend. There's differences in break evens between the stock and options. Now, dividends do impact option pricing, and the larger the dividend yield, the more it's going to impact, your right to buy shares at a price, because traders know that the stock is going to adjust down for that. But you can't vote options. You can't vote proxy with the options. Now, it's a little bit of there's a dichotomy here on break evens we talk about. Lower break evens with stock, and it could be higher or lower break evens with options. The reason why we mention this is with stock, when you buy shares of stock, your break even is what you paid for it. If the stock goes up a penny from what you paid for it, your break even is 1 penny down. Where if you buy an option, you're paying that premium that Jacob mentioned. Frequently, the stock has to move enough up or down, depending on the type of option you traded, to offset that premium you paid. And so with this, if you've bought the right to buy shares at $100 and the stock's at $100, well, if you paid $1 for that right, well, the stock has to go up $1 to then now you have $1 discount to offset that, and so you have a higher break even. Well, likewise, if you then bought the right to sell the shares at $100, well, the stock would have to drop enough to break even. So that's why that's higher or lower break evens. But then the flip side is what if you sold an option? Well, then potentially the stock can stay flat and you make money. And so your break evens again change compared to stock. With stock, if you buy shares of stock and it stays still, you don't make any money, you don't lose any money. With options, you can make a lot of money or lose a lot of money if the stock stays still. And this is a big, big difference between the two. Jacob, I know that was a lot of information that I kind of covered there with the differences between stock and options. You know, a lot of the reasons on why traders will trade options. Anything else that jumps out to you on those concepts?
No, I think we're ready to continue marching forward. Next, we're going to take a look at a nice little diagram here that breaks down the actual option types. So there is call options, and there are put options. These are the only options that we deal with as options traders are calls and puts. The call option is the contract allowing the buyer of the contract to buy shares. So we're always going to look at this from the buyer of the contract's point of view. The call option gives you the right to buy shares at the strike price up until the expiration, whereas the put contract is instead the obligation to sell shares at the strike price. We see how those are very similar and yet also a little different. Long call, the right to buy. Long put, the right to sell. But in order to have the right to sell, you are buying a put. That is the item you are purchasing. And in fact, that's why we've introduced here the word long and short. Long means that you bought it at the start. Long means you bought it at the start. And since you bought it at the start, you hold it. You are the holder of the option. Notice how the holder could be a holder of a put or the holder of a call. We've got the call and the put both, but we are long either one of those. But if you are long the call, you are bullish. Bullish is saying that you profit from the market going up. So if the market goes up, that is good for you. That's what we saw in Nick's prolonged example related to the toothpaste, that if it goes up to $10, your coupon is even more valuable. That is better for you. The higher up it goes, the better. And since we understand now that that is the case, we're looking at this and understanding that we have precisely that ability to measure our gains and our losses. We are now able to decide what works. So let's think of it instead as a stock. Let's suppose that there is a stock that we've got here at $50. The stock is worth $50. And if we would like to, we can buy the shares for $45. In other words, our strike price of our call contract is $45. Well, right now, there's an inherent $5 difference, isn't there? You can buy for $45, shares are worth $50. There's a $5 difference, and that should mean your call is worth at least $5. It might be worth more. But if the stock was worth $55 or $60 or $75, the higher up the price goes, the more your call is worth because you have a fixed price. That fixed price would be still $45, regardless of how high up the stock goes. The call's value would increase based upon that increase in the share price. Likewise, a long put has a value, and its value is based on the ability to sell shares. Let's suppose those same shares worth $50, but instead of a call, you own a put. Well, that put, whose strike price is still $45, allows you to sell your shares for $45. So first we pause for a second and we think, do you want to sell your shares for $45 while they are worth $50? No, not a chance. But put contracts do exist below the current market value. And that's because they give you the guarantee of being able to sell at that price up until the expiration date. You can imagine a scenario where that could be useful. I own the stock. I think it's going to go up, but I'm concerned. What if it doesn't? What if it goes back down? If the stock goes down from 50, let's say it drops to $40 per share. Well, now I do have some inherent value in the put because I can sell my shares for 45, but they are now worth only 40. That guarantee is what brings the value to either a call or a put. Now, it's important to note that though a put is the ability to sell shares, you do not have to own shares in order to buy a put. In fact, the assumption that this long put is bearish assumes you do not own shares. You don't own anything except for the put, which is a contract allowing you to sell shares. But remember, as the holder of the contract, as the buyer of the option, you have the rights. And as a result, you can't be forced to sell these shares. You don't even own them, potentially. And so if you choose to sell the shares, you could step out into the open market and buy those shares at the going price and then turn around and sell them. Now, these can be at least mostly intuitive as soon as the terms make sense. But as soon as we step down here to the bottom half of the slide, the short call and short put, this is where it gets a little bit tricky as a beginner to understand why and how this would work. If you are a short call writer, you sell something that you do not own. And what you are selling is the option. You sold it to the other person. And even though you didn't own it at the start, nonetheless, you sold it. And in fact, that's where the name comes from. You are now short the call. You sold it and you don't even have it. You're short a call. Or you are short a put. You do this because you are getting paid upfront today, money in your pocket. That premium is money to you. But it comes with a hook. It is a risk we're taking. We are now obligated to deliver shares or cash based upon the type of strategy. Let's suppose you buy a call and I am the one that sells it to you. If you buy the call, you have the right to buy shares. And since I short the call, I am the one that has to sell them to you. So that is only going to happen if it's good for you, the buyer of the call. You are the one that decides if you're going to buy the shares or not. And so as the seller of the call, I recognize I don't have control, and it's probably only going to happen if it's bad for me. But I'm willing to participate because I get paid a premium. What about a short put? A short put. A short put says, now I might get forced to buy shares because the buyer of the put has the right to sell shares. They will sell those shares to me as the short put writer. I'm then obligated to pay them cash for those shares, and the amount of cash is specified in the contract. It's the strike price. That's how much I have to pay. And in order to do so, that's what we're looking at. When I learned about options for the first time, I remember thinking, why in the world would somebody be on the short end of this? Think about the risk here as the short put writer. You're saying, I will buy those shares for $45 a piece, even if they are worthless. That's what you're saying. I guarantee I will buy them from you. That sounds like a lot of risk, and it is risky. But let me ask you this. Who tends to make money in the insurance world? Is it the buyers of insurance or is it the sellers of insurance? It is the sellers of insurance that have profits that they make, so long as they are judgmental, judicious, wise in their allocation of risk. What happens if you are an insurance salesman and one of your insured drivers crashes the car, gets speeding ticket, DUI. Yikes. You can bet that the rates on that insurance contract are skyrocketing, or you're canceling the contract. You're no longer able to get insurance here, sir. That's what's happening here. When you put yourself into the option seller's point of view, you must be the insurance company. You must manage your risk. If things go bad, the risk proves too large, larger than you expected, you end the contract. I'm done with this. I move on and on to other ones. But they make money by losing on a few, but winning on most. That's what happens when we deal with insurance. And that's what happens in the options market as well. If you choose to be the buyer of options, you are paying money up front, and you must overcome that initial cost in order to just break even. Whereas down here on the short end of the spectrum, you are making money up front, and that money is your profit that you have to lose. From there on, you're hoping to protect those profits and move forward. Nick, there's plenty we could talk about on this slide alone. Is there anything you feel we need to hit?
I think you hit a lot of fantastic points there. Some things I'd like to elaborate on, from a insurance example that you mentioned. I have heard of a lot of companies that have gone under with hurricanes and floods that have happened in Texas and Florida. And so, even though many companies in general, from an insurance perspective, might make money, without judicious risk management, you could go bankrupt too if you were an option seller. I do know of some traders that have taken their accounts negative because they were aggressive option sellers and the market really moved against them. And so I want to encourage you that before you start to do the more complex, more risky option selling, learn more, learn as much as you can. Now, that said, the other thing I like to add on to the slide is that there's more than one way to be bullish and more than one way to be bearish on this slide. Buying a call is bullish. So is selling a put. Both of them are bullish. Now, buying an option is also bullish on something called volatility, and selling an option is bearish on something called volatility. So with this, volatility being a concept of magnitude of movement, thinking it's going to move a whole lot, you do also need to compare it to how much the market expects movement. And this starts to get into some of those more complex topics like the Greeks that I strongly encourage you to learn more about. We actually really hit into both of those concepts in our intermediate 4-week class. But at its heart, I work with a trader that was trying to trade around earnings. And they bought a call. And they paid about $3.50 for the call. They thought the stock was going to move up $2, and earnings came and went, and it moved exactly what they thought it was going to do. Yet their call dropped in value from $3.60 to about $1.80 because the market thought the stock was going to move $5, not $2. Magnitude of movement. And so, therefore, even though the stock moved up, they lost money with the call. The trade to have placed would have been a short put. Bullish in direction, but bearish on volatility. And so with options with this, you have to be more specific than just, well, I think the stock is going to go up, or I think the stock is going to go down. You have to have specific outlooks on how much do you think the stock is going to go up or go down, and over what time frame. Well, I think it's going to go up $5. Well, great. Thinking the broader market's going to go up $5 over a year is very different than I think it's going to go up $5 today. And so with that, keep that in mind when you're trading options. Magnitude of movement is important. Long call, long put. Back to that example I mentioned on You could lose a lot of money if the stock stays still. Those options both tend to be losers if the stock stays still. Where short call, short put tends to be profitable. A short call is bearish, but if the stock moves up only a little bit, well, even though it moved up, it could still be profitable because of the lack of big movement. Being short a call, being short a put is typically profitable if the stock stays sideways. It's a way traders can make money off the stock not moving. Now, you could then, again, take biases of, well, I want to be profitable if the stock stays still or goes up, in which case short put would do that. Or I want to be profitable if it really moves up, in which case a long call would do that and would actually be more profitable if it moves a lot than a short put. And then the same can be said with the inverse, and that's really all this is inverses of each other. A long call being the inverse of a short call, a long put being the inverse of a short put, long and short being inverse of each other. Just keep in mind that this adds that third dimension, that it's not just the stock goes up or down. Volatility adds that third dimension because now it goes up with a little bit of movement, it goes up with a lot of movement, it goes down with a little bit of movement, it goes down with a lot of movement, is what this is displaying into. I thought I'd elaborate on that, Jake. I always like to elaborate on that with this particular slide.
Yeah, thanks, Nick, for walking through. So essentially, it becomes kind of this three-dimensional field, right? Where we're not just dealing with up or down. Now we have to deal with kind of the point in time and when this happens. This slide is just referencing what happens in relation to stock splits. Now, here's the important part. There's a whole bunch of math on here, but you don't care about the math, and the math doesn't matter. What the math is telling you is before a stock split and after a stock split, your trade is the same. So all that's happening here when you deal with a stock split is that the slices of the pie are getting subdivided, or they're getting smooshed together. If there was 8 slices in the pie and now there are 16 slices, well, 2 slices is still an eighth of the overall piece, right? So what happens is your option is adjusted such that you still have the same proportional value as what you would have before. Don't worry about the specifics. The first time and even every time it happens to you, feel free to call in to Fidelity. Our traders will walk you through the specifics of what's happening on your contract. You just need to know that the overall outcome is that it is done fairly so that you are not disadvantaged as a result of the split. Your gains or losses will be based on the movement of the stock up, down, or sideways during the lifespan of your trade, not based on the stock split alone.
Two quick things I want to add on to splits, just real quick. First is with many splits, a 2-for-1, a 4-for-1, that's pretty common. Generally, what's going to happen is, well, if you had a 100 strike option, well, now you're going to have 2 50 strike options if it was a 2-for-1, or 4 25 strike options if it was a 4-for-1. Reverse splits, things shift, and it's still the same total value like it was saying beforehand, $7,500, but well, now the option multiplier versus it being 100 might be 25 if it was a 1-for-4 on there. Those are the options on the option chain. You might see an ADJ for adjusted. It used to be that really to mess with those, you had to call into a Fidelity representative. You can now trade those online, but I want to strongly caution you against those, that if you see something that's just too good to be true, there might be a reason for that. And there are a couple stocks out there that have spun off, is merged, that have had weird splits that it might be making the option do funky things. And if you see the ADJ, as Jacob mentioned, you can always call in and get more information. Active Trader team at Fidelity is always happy to answer those questions.
And we can take good care of you, folks. When you pull up an options chain, by default, all of those are hidden so you don't accidentally stumble across it. You'd have to make choices on your option chain in order to make that something that you would see. But okay, let's take a look at this. What are some of the risks and the trade-offs that happen when we look at options trading? If you're going to be a buyer of option, good news is you get that leverage, and the leverage can work in your favor. Like Nick said, it can also work against you. It's that two-edged sword. But we also have a trade-off related to time. When you work with time, well, it's a one-directional road, right? It's one-way street down this road we call life. The further and further we get towards the expiration date, the less and less value your option has. At the start of your option's life, remember the 45 strike price put we talked about? That had value at the start, even though the shares were worth 50. It had value because the shares might go below 45, and I'm concerned about it, and I want to be protected against it. But the closer and closer we get to the expiration date, if the shares are still at 50, or if they've gone up to 55, 60, 70, 100, the higher up they go, or the closer we get to the expiration, suddenly the right to sell at 45 is really not very valuable or maybe even worthless. That passage of time does have an impact on the value of the contract, and it will decrease. So the passage of time is always going to be eating away of these. Again, to return to the grocery store with our analogies, these are like a gallon of milk. Closer and closer to the expiration date, those are the ones that get a lower price, a discounted price, because, well, frankly, there's only a few more days that this could be useful to somebody. Whereas if we come over and take a look at an overall options symbol here, we can see it's going to have several components, and this is everything that's specified on your option. For example, this one is going to start off with the stock or ETF symbol. So this is the security that we're working with. In this case, it's an ETF. Then it's going to be followed by a 2-digit year, 2-digit month, 2-digit day. So all of this is just the date altogether. Then a C or a P for call or put. Finally, the strike price. In most of our tools, you're going to see it instead written like this: the SPY January 21st, 2022 call at 2:08. But in some places, like on a trade ticket, you might still see this version, or you might see it somehow similar at another broker dealer. If you happen to come across this, you should be able to parse it out knowing these are the pieces that are in there: the security, the date, call or put, and the strike price. This would give someone the right to buy shares at 208. So just think through it as you're getting more and more familiar with this term. What does that mean? What if the shares of SPY were worth 210 right now? Is that good news for this? Probably, right? I can buy for 208, but they're worth 210. That sounds like I'm getting a good deal. Or if the shares went up even more to, say, 220, even better. The higher up they go, the better for me, because I have a guaranteed price at which I can buy, and they'll be worth even more and more. Whereas to the downside, if it goes down, what if they're worth 205 or 200 or 150? Well, the lower and lower the shares go, the less attractive the right to buy at 208 becomes. When we think about that, we're just slicing up the value of our contract to have two pieces. One is the actual intrinsic, tangible part of the options price, the ability to buy something for less than the current market value, or to sell it for more than the current value. That is the intrinsic value, or the in the money amount. And anything extra on top of that in the options premium, that's the extrinsic value, the extra. That's the out of the money value, or the time value, or the volatility value we could all attribute there. It's all the extra, intrinsic and extrinsic. When you think about your option, remember that there are those two pieces. And that's why an option, even if it is out of the money right now may still have value. In fact, if I go ahead and bring us over now to take a look at Active Trader Pro, and I'll bring up an options chain for SPY, you'll notice that its price is substantially above 208 currently. It's at 543. Things have certainly changed since we produced these slides. But as we take a look at this, we find various different expiration dates. I'm going to advance this forward and choose the one in September, which is called the monthly expiration. Our September 20th expiration date has many different strike prices available. And on our calls over here on the left-hand side, see where it says calls, we find that we could buy a call with 539 as our strike price. That sounds attractive. I can buy for 539, but the shares are worth 543. You might ask yourself, why would somebody sell that to you? Or why not just buy the shares at 543? What's going on here? Well, take a look. You would have to pay $14 to get the 539 strike price call. $14 plus 539, well, that's a handy margin more than 543. In fact, it's $10 extra. That extra that you're paying is the extrinsic amount. There was $4 of intrinsic value and an additional $10 of time value. If you right click up here at your header and click on time value, you'll be able to right click and hit add column. Then you can choose to add that as an additional value on here. And we see indeed there's about $10 of time value in this contract. Over here on the put side, you could buy that same 539 strike price put. But now that's the right to sell for 539. But the shares are worth more than that. Nobody wants to sell their shares right now for 539. But some people want the right to sell their shares for 539, just in case that's valuable. Just in case the shares go to 530 or 520 or all the way back down to 208. If they did, suddenly this would be a very valuable put contract. But I hope that makes sense why we're talking about this difference between calls and puts, intrinsic and extrinsic value. It helps us understand why it makes sense for those trades to happen. It also points out why there is no free lunch out there in stepping in and saying, I can buy these right now, guaranteeing a price of 539. No, absolutely you cannot. Somebody thought of that already, and it's already been taken into account. Likewise, on the put side, I could buy a contract right now that lets me sell for 548, $5 more than the current price. But in order to get that $5 better price, I'm having to pay $11. Does that sound like a good deal? Buy $5 and pay $11 for it? No, it doesn't. That's not why we trade options. We trade options for all the reasons we already talked about. For the leverage, for the guarantee, to manage our risk. These are the reasons we trade in the options market. Not for fancy risk-free opportunities. No, risk-free is not something we tend to run into in the investing world with any modicum of frequency. Nick, anything else you'd like to add for us here as we dissect the premium into intrinsic and extrinsic?
I would just like to touch on again that in the money doesn't have anything to do with being profitable. That if you purchased a call with the right to buy shares at $100 and you paid $5 for that call, and then let's say the stock is currently at 103. Well, $5 premium, 103 is where the stock is. You're able to buy the stock for a $3 discount. So you have $3 of intrinsic value, $2 of extrinsic or time premium with this. So you actually bought an option that was, quote, in the money. Now, if the stock stayed flat, eventually at expiration, the option is only going to be worth that intrinsic value. So go from being worth $5 to being worth $3 because it's the discount you get. I mean, the option is still considered to be in the money, even though you've lost money on that. Likewise, if you paid $1, even on top of that, resold the exact same call for another 25 cents to bring in more premium. Now, it did make financial sense for them to be assigned, but an option holder can exercise their option for any time or not. And sometimes you might wind up in a situation like that where there's a gift, so to speak, and it's like winning the lottery, and it doesn't happen very often, where you're assigned and you thank whoever it was that assigned you because it did make financial sense. You made out better for that. And sometimes even I've seen cases where traders have sold an option. The option is in the money, has intrinsic value at expiration, and they don't get assigned. And then you can kind of thank whoever it was that didn't exercise the right, that walked away from the premium. With that though, Jacob, I know we're at time. Anything that you might want to add to exercise or assignment as we wrap up?
Let me just add a nice resource for people if you're interested in learning more. I know this was a lot of material. We did our best to try and go at a slow pace and address questions along the way. But if you would like to refer to some of this information in the future, this is the spot for you to come. Fidelity.com/classroom. Do you see that up here at the top? I know it's small print. Fidelity.com/classroom. That will bring you to this page we're looking at right here. And we'll notice that there is a 4-week course dedicated to beginner options traders. If you'd like to learn more and this feels like the right pace for you, this material that we just went over, actually, Nick and I just pirated, if you will, straight from our 4-week course. This was week 1's material. So earlier today was the second week's material as well going on. All of that stuff is available and you can continue to learn. But I bring you to this not just so you can know that you missed out on week 2 and you'll have to wait till next month to revisit and go through the whole thing if you would like to, but actually right here, folks, you can get a copy of these slides right here. And that way you're able to go ahead and run through the things that we didn't have a chance for, as well as review the other material if you're interested. This gives you the slides for all 4 weeks in one solid go. Folks, thank you so much for being with us. It's been our pleasure. We look forward to seeing you back here soon. Until next time, Nick, it's been my pleasure. Thank you, folks, for all of your time. Take care.
Take care, everyone.